Every 2 months, the governors of the world's most powerful central banks board private flights to Basel, Switzerland. They enter a circular tower. No public minutes, no recorded votes, no oversight from any government on earth. The Federal Reserve answers to Congress. The European Central Bank answers to a treaty. The Bank of England answers to Parliament. But all three follow rules written somewhere else entirely. The institution that writes them was founded in 1930. It survived the Second World War untouched, while every institution around it collapsed. Today, it sets the standards every central bank on the planet is expected to follow, not through legislation, not through treaties, but through a system of voluntary compliance that no central bank has ever refused. This is the Bank for International Settlements, and it was never designed to be visible. In 2022, central banks across 4 continents raised interest rates within weeks of each other. The Federal Reserve moved first, the Bank of England followed, then the European Central Bank, then the Reserve Bank of Australia, the Bank of Canada, the Swiss National Bank. Exposed to different economies, different inflation drivers, different labor markets, and yet they acted in near lockstep. The official explanation was convergence. Global inflation demanded a global response, and independent institutions reached the same conclusion independently. But convergence doesn't explain the mechanism. It doesn't explain how dozens of central banks, separated by geography and mandate, arrived at the same policy framework, the same risk models, the same threshold for action at almost exactly the same time. Central bank independence is one of the most protected ideas in modern economics. The principle is straightforward. Monetary policy must be insulated from political pressure. Elected officials set fiscal budgets. Central bankers set interest rates. The firewall between the two is treated as sacred, and in most democracies, it is written into law. But independence from government is not the same as independence from each other. And it is certainly not the same as independence from the institutions that train their economists, publish their research frameworks, and convene their governors behind closed doors 6 times a year. The Bank for International Settlements hosts those meetings in Basel. It calls them consultative gatherings. No formal resolutions are passed, no binding agreements are signed, but the governors who attend return home with a shared diagnosis, a shared set of assumptions about where inflation is heading, what systemic risks are emerging, and which policy responses are appropriate. The alignment that follows is not legislated. It doesn't need to be. When every central bank draws from the same analysis, reviewed in the same room, the policies they announce 3 weeks later will look remarkably similar. Not because they coordinated, because the framework was already shared before the decision was made. The Bank for International Settlements was not created to coordinate monetary policy. It was created to move money from one defeated nation to the rest of Europe, and to make sure the payments never stopped. In 1930, Germany still owed war reparations from the Treaty of Versailles. The sums were staggering. The logistics were tangled across borders, and the political will to enforce collection was collapsing. The Young Plan, the final reparations framework, called for a neutral financial institution that could sit above national interests and administer the transfers. It needed to be fast. It needed to be trusted by creditor and debtor alike. And above all, it needed to be insulated from political interference. Switzerland was chosen deliberately. Basel sat at the intersection of France, Germany, and Switzerland itself, geographically neutral, financially sophisticated, and governed by a legal tradition that treated banking secrecy as constitutional. The BIS was incorporated under Swiss law, but granted something far more powerful than a corporate charter. Its founding agreement, the Hague Convention of 1930, gave it sovereign immunity. Its premises could not be searched. Its archives could not be seized. Its staff could not be prosecuted by any member state. It operated, in legal terms, more like an embassy than a bank. Within a year, reparations payments began to collapse anyway. Germany defaulted. The political architecture that justified the BIS crumbled before the institution had finished furnishing its offices. Any ordinary organization built for a single purpose would have been dissolved when that purpose disappeared. The BIS was not dissolved. It adapted. By the mid-1930s, it had quietly repositioned itself as a meeting place for central bankers. The reparations mandate was dead, but the infrastructure remained. The legal immunity, the Swiss jurisdiction, the private meeting rooms, the relationships between governors who had grown accustomed to sitting across a table from each other. What had been built to transfer payments became something more durable, a permanent forum where the men who controlled national money supplies could talk freely, beyond the reach of their own governments. Then the war came, and the BIS did something no other international financial institution managed to do. It continued operating. While the League of Nations froze and the global financial order fractured along battle lines, the BIS maintained accounts for both Allied and Axis central banks simultaneously. The Reichsbank and the Bank of England held deposits in the same building. Gold transfers passed through Basel that would later be traced to Nazi-occupied treasuries. After the war, the American delegation at Bretton Woods formally called for the BIS to be liquidated. The resolution passed. The Bank for International Settlements was scheduled for dissolution. It was never carried out. The institution survived its own death sentence, and within a decade, it had become more influential than at any point in its history. By the 1960s, the Bank for International Settlements had survived reparations, a world war, and its own scheduled dissolution. But it still had no formal authority over any central bank. It couldn't issue directives, it couldn't impose sanctions, it had no enforcement mechanism whatsoever. What it had was something more useful, a room where every major central banker already showed up voluntarily. The shift from forum to standard setter began not with a policy paper, but with a crisis. In 1974, two banks collapsed in rapid succession. Bankhaus Herstatt in West Germany failed mid-settlement, leaving counterparties across the Atlantic holding worthless claims. Franklin National Bank in New York followed weeks later, at the time the largest bank failure in American history. Both collapses exposed the same vulnerability. When a bank operating across borders failed, no single regulator had the jurisdiction or the information to manage the fallout. National banking supervision had been built for national banks. The financial system had already outgrown it. The BIS moved quickly. It convened a new body, the Basel Committee on Banking Supervision, composed of regulators from the G10 countries. The committee had no legislative power. It could not compel any member state to adopt its recommendations, but it operated from within the BIS infrastructure, met on BIS premises, and published its findings under the BIS umbrella. Its first mandate was narrow: establish shared principles for supervising internationally active banks. The result, published in 1975, was the Basel Concordat, a framework for dividing supervisory responsibility between home and host countries. It was not a treaty, it was not ratified by any parliament, but within a decade, it had become the baseline assumption of cross-border banking regulation worldwide. Then came the debt crisis of the 1980s. Latin American sovereign defaults sent shockwaves through the balance sheets of the world's largest commercial banks. The question was no longer just who supervises international banks, it was how much capital they need to absorb losses before they collapse. The Basel Committee had the infrastructure, the relationships, and the credibility to answer it. In 1988, it published the Basel Capital Accord, Basel I. The framework introduced a single, deceptively simple metric: a minimum capital ratio. Banks operating internationally were expected to hold capital equal to at least 8% of their risk-weighted assets. The number was not derived from a mathematical model. It was a negotiated threshold, hammered out between regulators who needed a figure strict enough to mean something and flexible enough to survive domestic politics. 8% was the compromise. No law required any country to adopt it, and yet by the mid-1990s, over 100 countries had written Basel I into their national banking regulations, including nations that had never been invited to the negotiating table. Basel II followed in 2004, expanding the framework into three pillars: minimum capital requirements, supervisory review, and market discipline. It introduced internal ratings-based models that allowed banks to calculate their own risk, a mechanism that critics would later argue gave the largest institutions exactly the flexibility they needed to understate their exposure. Basel III arrived in the aftermath of 2008, tightening capital buffers, introducing liquidity coverage ratios, and adding leverage constraints that hadn't existed in any previous version. Each iteration was more complex, more technical, and more deeply embedded in the regulatory infrastructure of every participating nation. None of the three accords was ever passed by a legislature. None was ever signed as a treaty. None carries the force of international law. And yet, no major economy has ever refused to implement them. The BIS had engineered something more effective than a legal mandate, a standard so deeply integrated into the machinery of global banking that opting out became structurally impossible. A country that rejected Basel standards would see its banks frozen out of international capital markets, its sovereign credit rating downgraded, and its financial institutions treated as unregulated by every counterparty that mattered. The BIS didn't need enforcement power. It had built something better, a system where compliance was the only rational choice. 6 times a year, the governors of 63 central banks travel to Basel for what the BIS officially describes as bi-monthly meetings. The gatherings last 2 days. There are plenary sessions, working dinners, and smaller breakout discussions organized by region or by topic. No formal minutes are published, no votes are taken, no binding resolutions emerge. The BIS characterizes these meetings as opportunities for central bankers to exchange views in a setting of mutual trust. What it does not characterize is the degree to which those exchanged views converge into shared action within weeks of every gathering. The most consequential meetings happen in the smallest rooms. The Global Economy meeting convenes the governors of roughly 30 central banks, the institutions that collectively oversee approximately 80% of global GDP. Within that group sits an even smaller circle, the Economic Consultative Committee, limited to 18 governors who meet privately before the plenary sessions begin. The discussions are unrecorded. The attendees set their own agenda. The only public evidence that these meetings took place is a line item on the BIS calendar and the occasional reference in a governor's speech months later. But the coordination is visible in the data. In March 2023, following a weekend of meetings in Basel, central banks across 3 continents issued statements within days of each other using nearly identical language on inflation expectations and financial stability risks. The Federal Reserve referenced ongoing vigilance in the face of persistent price pressures. The Bank of England used continued vigilance amid sustained inflationary pressure. The European Central Bank warned of persistent underlying price dynamics requiring sustained attention. 3 institutions, 3 separate mandates, 3 different economies, and phrasing so similar it could have been drafted from the same briefing document. That is because, in practical terms, it was. The BIS Research Department produces analytical papers, data compilations, and risk assessments that are circulated to member central banks before every bi-monthly meeting. These are not public discussion papers. They are internal briefing materials, shared frameworks for interpreting global conditions. When a governor sits down at the plenary table in Basel, the diagnosis has already been written. The meeting does not produce consensus, it distributes it. The mechanism extends beyond language. The BIS runs training programs for central bank staff through the Financial Stability Institute, courses on supervisory methodology, stress testing techniques, macroprudential frameworks. Over 5,000 officials from more than 170 jurisdictions have passed through these programs. The curriculum is set by the BIS. The models taught are BIS models. The risk frameworks embedded in the training become the default operating assumptions of the officials who return home to write policy for their own institutions. It is not a conspiracy, it is infrastructure. When central banks hire from the same talent pipeline, reference the same research, attend the same meetings, and train their staff in the same methodology, the result is not coincidence, it is architectural. The BIS does not need to issue instructions. It sets the conditions under which independent decisions reliably produce the same outcome. The question is not whether this coordination exists. The question is, what happens when 63 central banks operate inside a framework designed by an institution that answers to none of them, and none of their governments? On September 15, 2008, Lehman Brothers filed for bankruptcy. Within 72 hours, the global financial system experienced something closer to cardiac arrest than a market correction. Interbank lending froze. Money market funds broke the buck. Credit default swap exposure that had been modeled as manageable turned out to be catastrophically concentrated. Banks that had passed every Basel II stress test 6 months earlier were suddenly insolvent, or close enough that no counterparty was willing to find out. What followed was the most synchronized central bank intervention in history, and the speed of it revealed something the architecture of the previous 4 decades had made possible, but never made visible. On October 8, 2008, 23 days after Lehman collapsed, 6 central banks cut interest rates simultaneously. The Federal Reserve, the European Central Bank, the Bank of England, the Bank of Canada, the Swiss National Bank, and the Swedish Riksbank all moved on the same morning. Same direction, same magnitude. The Reserve Bank of Australia had already cut the day before. The Bank of Japan issued a statement of support within hours. China's central bank followed before the week was out. There was no treaty that required them to act together. There was no formal agreement, no emergency protocol filed with any international body. And yet the coordination was seamless. Not approximate, not loosely aligned, but synchronized to the hour across 6 time zones. The mechanism was the BIS. In the weeks between Lehman's collapse and the coordinated rate cuts, the BIS convened emergency consultations among the governors who already knew each other from years of bi-monthly meetings in Basel. The relationships were already built. The analytical frameworks were already shared. The models used to assess systemic risk had been developed in BIS working groups and taught through BIS training programs for over a decade. When the crisis demanded immediate, coordinated action, the infrastructure didn't need to be constructed. It was already in place. It had been in place since before most of the governors involved had taken office. But rate cuts were only the beginning. Over the following months, the Federal Reserve opened emergency dollar swap lines with 14 central banks, an unprecedented move that effectively made the Fed the lender of last resort, not just for the American banking system, but for the global one. The framework for those swap lines had been discussed in Basel. The BIS had published research on cross-border liquidity shortages years earlier, mapping exactly the vulnerability that Lehman's collapse had now exposed. The solution was not improvised, it was deployed. The coordinated response continued into 2009. Quantitative easing programs launched in the United States, the United Kingdom, and the Eurozone followed parallel structures. Large-scale asset purchases targeting government bonds, designed to compress long-term yields and force capital into riskier assets. The scale varied, the timing differed by weeks, but the underlying logic was identical, and it had been refined in the same working groups, reviewed in the same briefing papers, and discussed over the same private dinners in the same tower in Basel. Critics would later argue that the response saved the financial system at the cost of moral hazard, that by backstopping the largest institutions without conditions, central banks guaranteed that the next crisis would be bigger. Supporters countered that without coordination at that speed and scale, the collapse would have been uncontainable. Both arguments are valid, but neither addresses the structural question underneath. The system worked in 2008 because it had already been built to work as one, not through legislation, not through treaties, through decades of shared frameworks, shared training, and shared assumptions, engineered inside an institution that most of the world's population has never heard of. The crisis didn't create the coordination, it revealed it. In 2019, the BIS launched what it called its Innovation Hub, a network of research centers in Hong Kong, Singapore, Switzerland, London, Stockholm, Toronto, and several other financial capitals. Its stated mission is to explore emerging technologies relevant to central banking. Its primary focus, from the beginning, has been central bank digital currencies. As of this year, over 90% of the world's central banks are actively researching or piloting a digital currency. More than 30 have launched live programs. The Bank of England is developing a digital pound. The European Central Bank is building a digital euro. China's eCNY has already processed transactions worth billions. Each project is presented as a sovereign initiative, designed domestically, governed nationally, answering to local mandates. But the design principles underlying nearly every major CBDC pilot trace back to BIS working papers. The 2-tier distribution model, where the central bank issues the currency and commercial banks handle public-facing transactions, was outlined in BIS research before any single nation adopted it. The privacy frameworks, the interoperability standards, the cross-border settlement protocols being tested right now between the central banks of Singapore, Malaysia, Australia, and South Africa are running on a BIS platform called Project mBridge. The infrastructure of the next monetary system is being prototyped inside the same institution that built the infrastructure of the current one. This is what makes the BIS unlike any other international organization. The IMF lends money under conditions that borrowing nations can accept or reject. The World Bank funds projects that recipient countries can decline. The United Nations passes resolutions that member states routinely ignore. The BIS does none of these things, and its influence is more durable than all of them. It does not lend, it does not fund, it does not legislate. It provides the intellectual architecture that central banks absorb voluntarily and implement as if the ideas were their own. Consider what that means structurally. When the Federal Reserve adjusts its capital adequacy framework, the adjustment reflects Basel III standards developed at the BIS. When the Bank of England redesigns its stress testing methodology, it draws on models published by the BIS Financial Stability Institute. When any central bank in any country evaluates systemic risk, it uses a definition of systemic risk that was codified in Basel. The BIS does not control the decisions. It shapes the frame through which every decision is made. The institution's annual report, published each June, freely available, and almost never covered by major media, lays this out with unusual candor. It describes a global monetary system that requires coordination to function, coordination that requires shared standards, and shared standards that require a permanent institution to maintain them. The BIS presents itself not as a regulator or a policymaker, but as the necessary center of a system that would fragment without it. And on the evidence of the last 96 years, that assessment is difficult to challenge. There are no conspiracy theories needed here. The BIS publishes its research, it names its committees, it lists its member central banks. Everything it does is technically available for public scrutiny. But the gap between technical availability and genuine public awareness is vast. And it is in that gap that the most consequential financial architecture on Earth continues to operate, largely unexamined by the legislatures, the journalists, and the populations whose economies it shapes. The Bank for International Settlements was designed for a world that no longer exists. The reparations are gone, the architects are gone, but the institution remains, older than the United Nations, older than the IMF, older than the World Bank, quietly setting the rules that every central bank follows, answering to no government, accountable to no electorate, and building the infrastructure of whatever comes next.